Hello, everybody. This is Steve Gorin, and thank you for attending today's webinar, When a Gift is Subject to Income Tax, Beneficiary Deemed-Owned Trusts, Making Large Taxable Gifts. Before we begin, I wanted to cover a few housekeeping items. If you have any questions during the webcast, you can submit them through the Q&A widget at the bottom of your screen. I'll see whether I can answer these during the webcast. But if a fuller answer is needed or we run out of time, it will be answered later via email, or preferably, you will join me for the WebEx call afterwards that starts. We'll have a little break for 10 minutes after the webinar is over, and then we'll have about a half an hour reserved for just live discussion on WebEx. A copy of today's slide deck, as well as other reference materials, are available in the resource widget. The materials consist of my third quarter newsletter, the articles of which are the basis for today's webinar. You can also find these materials on our website. We encourage you to download any resources or links you may find useful. And of course, my newsletter has links to my full 2,600 pages of materials that you can just download and save and keep on your system as a PDF. You can find additional answers to some common technical questions located in the help widget at the bottom of your screen. This webinar is CLE accredited in California and Illinois for 1.5 general credit, and Texas for 1.5 general credit where it is pending, and in Missouri for 1.8 of general credit. We award CLE based on attendance for the entire 90 minutes. From time to time, you will be required to click a pop-up screen to reflect your continued engagement. The certification icon located at the bottom of the screen will only tell you if you have met our criteria for awarding CLE. It does not include the certificate of attendance. Once we have verified your attendance, your certificate will be emailed to you later tomorrow. This webinar is being recorded and will be available within 24 hours. You can access it from our website at www.thompsoncoburn.com. All in attendance will also receive a link to the recording. Please do not hesitate to share it with other professionals who may find it useful. And of course, if certain parts stand out, then they can fast forward the recording to those parts. When the CLE is done, after a 10-minute break, I already mentioned, I'll be hosting a live discussion through WebEx. You should have received a calendar invitation to the discussion. All of you who pre-registered in advance received one yesterday afternoon, and then we had another person who registered today who received it today. We value your opinions and appreciate your participation in the course. Okay, so here we go. I'm going to talk about when a gift is subject to income tax. That's going to be the first maybe more like 15 or 20 minutes. We'll talk about Beneficiary Deemed-Owned Trusts, and that'll be for about half an hour, and then Making Large Taxable Gifts, which will be the balance of the time. And really all three of these fit into the theme of large year-end gifts for people to use up their exemption. So when a gift is subject to gift tax, so I'll talk about how bargain sales to individuals and charities work, including the effect of debt. I'll talk about a unique 2020 opportunity to donate assets whose sale would otherwise generate UBTI to that charity that sells it. And I'll also talk about when gifts of deferred income assets will trigger gain recognition, including some traps to avoid when you transfer business interest, some transfers that you wouldn't think would trigger income tax, but they do. So bargain sales to individuals and charities. So if you have a bargain sale, then it's a part sale and part gift. And so with a bargain sale, it could be a sale for cash or a promissory note, or you could be transferring property that's subject to liabilities. And so the donee is assuming those are liabilities, or just taking responsible for paying those off. So if the donee is not a charity, Then what you do is you look at the sale proceeds and debt transferred and compare that to your basis. And if those exceed the basis, then there's gain. If they don't exceed basis, you're not going to be getting a loss because it was a donative transfer. If it's a charitable donee, then you have the same calculation for the proceeds and debt, but your basis gets prorated between the gift portion and the sale portion. So you look at the value of the property and you figure out what portion of that is a gift. So that would be the excess of the value over whatever you got back. And then you would be prorating the basis, and then you would apply that basis against the proceeds. So consider about when you donate assets whose sale would generate unrelated business taxable income. So what does this mean? So charities are subject to income tax to the extent a sale constitutes unrelated business taxable income. Now, the normal rule is that when a charity sells an asset, there's not going to be subject to unrelated business income tax on it. However, when it comes to business property or certain particular types of sales, there may be exceptions. So if the charity receives some fully depreciated equipment and it sells that, then that's depreciation and recapture. That's going to be unrelated business in taxable income. How about a partnership or sole proprietorship? And by a sole proprietorship, I'm really thinking of a single member LLC, and then you donate the single member LLC. So your partnership or your sole proprietorship may have some debts associated with it, and so when you donate that, then you need to think about the assets, the liabilities are associated with it. And as I mentioned before in the prior slide, there's a bargain sale when you transfer that to the charity, but then when the charity disposes of it, in unrelated business taxable income, there's a concept called debt financed income, and debt financed income is subject to unrelated business income tax. So basically, when the charity sells a property, it would need to kind of figure out how much of those of that property was financed by debt. So there's a lot of complicated rules. You'll see in there. You'll see, by the way, there's a parenthetical in here, and you'll see there's this. By that second bullet point, there's that really small one, 2Q6D Romanet 1. So that's the link to my 2,600-page PDF. Now, like if you're in the article itself that goes over this topic, you can just click on where the article references 2Q6D1, and it will take you to the page that includes the beginning of 2Q6D1. But if you're not in the article, you can just have my big PDF open, and you can just copy and paste that from the slide to 2Q61, and it'll take you to that part. Okay, how about an S corporation? K1 from an S corporation is, by definition, 100% unrelated business taxable income that is taxable to the charity. Doesn't matter what the nature of the income is inside the S corp. The S corp can hold, for example, marketable securities portfolio, and interest and dividends are not subject to unrelated business income tax, nor is the sale of marketable securities subject to unrelated business income tax if the charity owned that directly. But if it's held through an S corp, all that stuff that flows through on the K1 is automatically unrelated business taxable income, even if normally that income would not be subject to that. So S corps are kind of poison in this unrelated business taxable income idea. Also, if you sell stock in an S corporation, the whole gain on that is also unrelated business taxable income. Now, going on to the next slide, there is a charitable deduction against unrelated business taxable income. And here's the key. If you donate the business interest directly to a charity, then that charity, the ultimate charitable beneficiary, that charity will not really be able to shelter that unrelated business taxable income. But if you donate the business interest to a donor-advised fund or a supporting foundation, the logistics are that intermediary entity will be reporting the income, but then that intermediary entity will be making distributions to the ultimate charity. So that intervening entity will get a charitable deduction for the distributions that it makes to the ultimate charity. So, for example, I had a client. He wanted to donate a business interest to his synagogue. His synagogue was not really well staffed for business interests, and instead I did a donation through a national donor advised fund, and that national donor advised fund actually had in-house lawyers, and it didn't cost the client a dime, and to do this transaction in terms of counsel for the charity, and then he was able to, after they received the cash, within a week, he was able to grant that money over to the synagogue from the donor advised fund. And if there's any unrelated business taxable income that the donor advised fund received, it would get a charitable deduction for that donation to the synagogue. And there are some donor advised funds, or probably a lot of them, they grant out so much money that it doesn't even matter if your account makes the distribution out to the charity. They've had such massive distributions to charities that they have plenty that are able to do that. And I do have a particular donor advised fund in mind, but I'm not going to turn my presentation into a commercial. So if anybody wants to know who I think the best donor advised fund is for this, and how you can do transactions with practically no cost, then I'm delighted to tell you offline. So here's the deal. This intermediate charity, this a donor advised fund or supporting foundation, it can be set up as a trust or as a corporation. And the one I'm thinking about is set up as a trust. Now, a trust, if it's going to have unrelated business taxable income, is going to be taxed at, you think about if you sell an asset, that would be typically taxed at capital gain rates. So you'd have a 20% top capital gain rate. You may have, if the state nails you with unrelated business income tax, then you may have a state level tax as well. And the capital gain rate would be normally 20% at the highest rate for a trust. But if you have depreciation recapture on equipment, then that would be at 37% this year for federal. So you'd have the income tax at that rate, but the trust would get a deduction which is based on the individual deduction limitations. And again, if the trust is donating cash, it's donating the sale proceeds. So it's selling the asset. The donor advised fund is selling the asset and then donating cash. So when it donates this cash, that cash would be eligible for the normally 50% deduction, and of course the 2017 tax reform upped that to 60%. But then for 2020, we have a special rule that you have a 100% deduction available for charity. So 2020 is a great year if you would like to do some kind of transaction to, for example, cash out some S-Corp stock. So normally cashing out the S-Corp stock, that's going to have, unrelated business income tax on the whole gain. But 2020, you can run it through the donor advised fund, and because of this 100% deduction, there will be zero gain on that. So 2020 is a great year to do that. And now, if you're intervening, donor advised fund or supporting foundation as a corporation, normally that income would be taxed at a 21% rate, but corporations get only a 10% deduction. So in most cases, you're going to want to have a user donor advised fund that is taxed as a trust. Now, for those you might have like a community foundation that might have a tolerance for holding business assets long term. Some of those community foundations will have their intervening fund be set up in corporate form so they can receive unrelated business taxable income every year and pay at the lower 21% rate compared to a trust being taxed at ordinary income at the higher 37% federal rate. So, it all depends. But if you have a really savvy charity, they may have both a trust form and a corporation form available to support it. Okay, let's go on to gifts of deferred income assets, and the first one is kind of the more obvious thing. If you have a note from an installment sale and you make a gift of it, that's going to trigger the deferred income, being brought in. So if you're going to make a gift of that, you might make a gift to an irrevocable grantor trust to avoid any income tax transaction. And then I'm going to talk about a couple other things on this next bullet point in the slide. But again, if you have irrevocable grantor trust as your donee, then all of the problems I described so far, in terms of bargain sale or triggering accelerating this income, all of these problems fall away while it is a grantor trust. And then if you turn off grantor trust status, then you need to be careful about that, about turning it off. Okay, so the second bullet point would be if you have an interest in an opportunity zone, which often is held in a qualified opportunity fund. So what is that? This came in with 2017 tax reform, and basically the goal was to provide incentive to invest in impoverished areas so you can have a boost up. Now, those impoverished areas are based on, I think it was like the prior census or something like that. And so some of those areas that were impoverished at the time that all the information got gathered are no longer impoverished. So there's a little bit of a loophole there. But at any rate, if you invest in a business in an opportunity zone, then you are allowed to roll over your gain. Basically, you roll over your long-term capital gain from other activity. You could sell marketable securities and take the amount of the gain and put them into the qualified opportunity fund, and that will defer that gain. Now, I'm not going to go over all the nuances of opportunity zones, but what my point is that you may have a client who has an interest in a business, And that client might have rolled over their gain from something into that business. And if that client makes a gift of that business, and that gift is not to a grantor trust, then that rolled over gain would be accelerated. And I mean, sometimes you might be able to tell by the name of the entity whether it's a qualified opportunity fund, but it's not necessarily going to have that name. So you would want to check if you have a client who's invested in the business in the last few years. You want to check to see whether that is in a qualified, that's like a qualified opportunity fund or the equivalent, because it may be accelerating gain. The other is a direct or indirect gift of a carried interest. And this also came in with 2017 tax reform. So for years and years, people have been complaining about, like, hedge fund managers. They, instead of taking a salary, they just simply take an interest in the profits of their fund. And a lot of times that profit that they get is going to be long-term capital gain when the hedge fund sells whatever it is it owns. So the issue is that people are, they're doing work, they're getting paid for their work using long-term capital gain, which of course is not necessarily fair to the rest of us poor schlubs who we're working for a living. We have ordinary income and self-employment tax or FICA tax. So there's a big uproar on that, and let's really stick it to the hedge fund managers who are getting these unfair benefits. And they did something that they enacted a statute, Code Section 1061, which on its face it kind of looks innocuous. If you hold something, if you have an interest, basically a carried interest, and you sell that carried interest and you sell it within 3 years, it's going to be short-term capital gain instead of long-term capital gain. So that looks kind of innocuous on its face. But there is a provision that talks about transfers that are not sales that could still accelerate income. And there's some proposed regulations out, and they take the position that a gift, other than a gift to an irrevocable grantor trust, if you give a gift to a related person, that will generate a deemed sale of the carried interest and whack you with short-term capital gain. So what the heck is a carried interest? How do you figure out what it is? I mean, there are certain types of businesses that it needs to be in before it can be a carried interest. But the bottom line is, do you have an interest in the profits that's disproportionate to your interest in the partnership's capital? So if you have this joint where there's a different percentage of profit sharing compared to capital, then you would look to see whether it's a carried interest. It gets better though. You don't just look at the business interest you're giving away. You need to look at everything that business owns, and you drill down any partnerships that it's invested in. Do any of those involve carried interest? So this is not simple. It's a difficult issue. The proposed regulations, in some ways, are a little overreaching, and things that may get caught by the proposed regulations, well, they might not actually get caught in the final regulations. So I'm just trying to do a warning out there. If you see profits interests that are disproportionate to the capital, set off your alarm bells. If your client has a business and it invests in something that has that characteristic, then set off the alarm bells. So, not saying there's going to be tax, just want to know when you're going to spot this issue. All right, let's switch gears to a beneficiary deemed-owned trust. So, probably all of you are familiar with the idea of an irrevocable grantor trust. So, an irrevocable grantor trust is a trust that's outside of the estate tax system, because it's an irrevocable trust and you haven't retained any powers that would drop back into your estate. So you've made your complete a gift to this irrevocable trust, and yet the grantor trust rules will treat you as the owner for income tax purposes. And irrevocable grantor trusts are, of course, the way that most of us estate planners like to do any sizable transactions to be able to try to avoid income tax on those transactions. Now, if the grantor is not the deemed owner under the grantor trust rules, you might be able to set up the trust so that the beneficiary is the deemed owner. And so I'm going to walk through this. This is an important strategy to know, because at the very end of when I talk about making large taxable gifts, I'm going to come back to something that involves a beneficiary deemed-owned trust. So first I'm going to talk about how 678A, the rule that makes the beneficiary the deemed owner, works, and its relationship to the grantor trust rules for grantors. And then I'm going to talk about how lapses of withdrawal rights affect the design of these beneficiary deemed-owned trusts, where the beneficiary is the deemed owner for income tax purposes. And we talk about planning and structuring a sale to a beneficiary deemed-owned trust, and also about fiduciary income tax advantages and disadvantages. So now, mechanics of how you make something be a beneficiary deemed-owned trust. So again, it can't be owned by the grantor. So that is 678B, that says that if the grantor is a deemed owner, then any of the taxable income that would be treated as owned by the grantor cannot be deemed owned by the beneficiary. Now, 678B does use the word income, but if you really drill down and look at all the different authorities on it, that really refers to the taxable items, not just income versus income in principle, but that income there just means the taxable items. In order to have the beneficiary be the deemed owner, there's a two-step process. So first of all, if the beneficiary has the right to withdraw the income from the trust, then the beneficiary is the deemed owner of whatever the beneficiary can withdraw. Now, what if it's not a pure withdrawal right, but the beneficiary is the trustee, and the beneficiary can make distributions to himself or herself? In that case, you need to look at the language for what is the reason for making the distributions. If the distributions are for an ascertainable standard, such as health, education, maintenance, and support, then that's deemed to be something that is subject to review by a court, subject to challenge by a beneficiary, and that is not deemed to be like an absolute right type of thing. So if you have an ascertainable standard, then the case law is very clear that that does not count the same as a withdrawal right, and that does not make the beneficiary the deemed owner. What if you have a standard that's not ascertainable, like welfare or best interests? So I believe that the case law would support treating that the same as a withdrawal right. So it needs to be a withdrawal right or the equivalent. I mean, if the beneficiary can make distributions for his or her own at his or her own whim, to him or himself or herself, then it that's the same as being able to withdraw. Now, some states, well, most states have something that says if the beneficiary is the trustee, then the beneficiary cannot withdraw for their own welfare or best interest. It has to be ascertainable. And so the only way in those states, and that includes most of the states I practice in, the only way that you can have that distribution for welfare or best interest with the beneficiary being the trustee would be if you turn off that restriction. So there's that 678A1 is a withdrawal right. So then what if you have a withdrawal right and you don't exercise it? Isn't that kind of like giving the money to the trust? Well, for estate and gift tax purposes, the rule is that if the withdrawal right that lapses no greater than the greater of $5,000 or 5% of the trust assets, then that doesn't constitute a gift. Now, and what you'll wind up happening with trust is you'll have that withdrawal right like that, and depending on the trust, if it's like a gifting trust where you're using the annual withdrawal rights called crummy withdrawal rights, those tend to be greater than that 5 and 5 amount. And then what you do is you'll have these large these gifts that like the annual exclusion gift that exceeds that 5 and 5 amount, and then what they'll do is they'll lapse it to the extent of that 5 and 5 amount. Usually I just go with the 5%. I kind of ignore the 5,000 in most cases, but I'm going to give you an exception in a moment. And then anything that doesn't lapse is what we call a hanging power, which is an ongoing withdrawal right. So for the ongoing withdrawal right, again, 678A1 is going to kick in a portion of that trust being subjected to the being deemed ownership. Now, what about the part that lapses? Well, even though for gift tax purposes that's not a gift, for income tax purposes, Code Section 678A2 says that if you partially release or modify the withdrawal right, then you would be deemed the owner of that part of the trust too. Now, is a lapse of withdrawal right the same as one of these partial releases or modifications? Well, you could argue either way, but there's a plethora of letter rulings that will treat it as a lapse as the same as a partial release or modification. So most lawyers are comfortable with treating the lapse of a withdrawal right in that manner, even though it's not absolutely clear under the statutes. Now, the IRS, I mentioned they had private letter rulings. The IRS, a few years ago, decided to stop issuing those letter rulings, except in very rare circumstances. That's because we were having people who were beneficiaries selling to their trusts, and the IRS didn't like the fact that they were able to move assets without there being a gift. So it's not that it's bad to do it, it's just that the IRS didn't want to bless it. So they haven't been issuing private letter rulings in that area. So what I prefer to do for that is I suggest that the trust, even though it could use the beneficiary social security number as a tax ID, I recommend that the trust get its own tax ID, file annual 1041, and use a grantor information statement to report the taxable items. Okay, next slide, lapses of withdrawal right. There's an issue about whether creditors can get to withdrawal rights. So first of all, while the withdrawal right is outstanding, so if the beneficiary has an absolute right to some money, generally the creditor should be able to get to it, but you may have some statutory exceptions for that, and you may purport in your agreement to prevent that. Then the next question is, well, what if your withdrawal right lapses? Have you made a gift to the trust? Well, we already mentioned for income tax and gift tax issues. What about for state law issues? So do the creditors get to count it as if you had made a gift to the trust, and now you're the settler of a portion of the trust? And in those states that do not provide sponsor protection for self-settled trusts, then your creditors can get to it. So the answer is that varies by state. The Uniform Trust Code, which is adopted by most of the states, will basically say that that to the extent the withdrawal right was just an annual exclusion gift, then they're not going to count the lapse of that as something which is going to subject it to creditors. Some states go even further, and they don't care how big it was. They'll give you protection. Other states don't give you that protection at all, and those states include New York and California. Now, I don't understand. Crummy trusts have been around for years and years, and I'm not sure why people in New York and California are not concerned about the issue that their crummy trusts are subjected to the beneficiary's creditors. But that's the law in those states. So if I were in those states and creating an irrevocable trust, I'd want to consider doing it in another state where they have trust law that protects against the creditors. All right. So the lapse of withdrawal right can subject you to creditors. So again, it may or may not. We already talked about the lapse of the 5 and 5 being a gift. Designing a trust that's wholly owned by the beneficiary from inception. So here's the deal for this. You fund a trust with up to $5,000. You put that money into a non-interest-bearing account. You provide that withdrawal right will lapse after perhaps 30 days. Some of you may be fine with 15 days. Some of you may be comfortable with 45 days, whatever. But you hold in a non-interest-bearing account and let that withdrawal right lapse, and then you take the position that the trust is a 100% grantor trust, taxable to the beneficiary from here on out, so the beneficiary can make sales to it. I mentioned the interest-bearing account. It's important to do that. Let's suppose you put the $1,000 into this account, and your withdrawal right was over the $1,000, and then the account grew to $1,005, and then the $1,000 withdrawal right lapsed. Well, that $1,000 was not the entire amount in the trust. You had $1,005 in the trust. So your trust is deemed owned by the beneficiary to the extent of 1,000 divided by 1,005. And it's not deemed owned by the beneficiary to the extent of 5 divided by 1,000. So then, whenever you do a sale to the trust, you're going to have an issue of potential gain on that sale. And then your tax return is not going to be 100% deemed owned by the beneficiary. So it can be pretty messy. So that's why I like to have it be a non-interest bearing account for that. Now, there are people who will have something which they call a BDOT. And there's no difference between any of this. All of these are beneficiary deemed-owned trusts, so they should all be called BDOT. But there's some language in the parlance. The first one that I mentioned with the $5,000 and withdrawal right lapses after 30 days, et cetera, that is very widely promoted by somebody who calls it a beneficiary defective inheritors trust, which is abbreviated BDIT, which I would pronounce beat it. Now, I would never name my technique after a Michael Jackson song, so I don't, I still will use the term beat it because people know what that means. But that is what the abbreviation, the commonly used term for that $5,000 thing is a beat it. And then there's another idea called a BDOT, which again really could describe everything here. But what that is when you have a right to withdraw, and that taxes you as the owner of the income that you could have withdrawn. And so that's called the BDOT. So then the question is, what if you do a sale to this BDOT that has this unlimited withdrawal right that might lapse over time? So an unlimited withdrawal right over the income. It's not a withdrawal right over the corpus. Well, when your withdrawal right lapses, what portion of the trust has been subjected to that lapse? Remember my example about the $1,000 and $1,005. Well, if you're only going to be pulling out the income, if your withdrawal rate is only out of the income, then it's only that amount of income that it's lapsed over. So you would take the amount of the lapse and divide it by everything in the trust, and that's the portion of the assets that are deemed owned by the beneficiary. That is less than 100% of the trust. Now, so I don't believe in having sales with the so-called BDOTs. I do have another way to do it that I'm going to mention later that gets around these issues when you want to have a larger gift. Okay, slide 11, sale to a 678 trust. So my materials go and discuss a GRAT versus a sale to an irrevocable grantor trust. I'm a believer. I tend to be a believer in the sale to irrevocable grantor trust. A problem with a GRAT, if you have a business interest, is valuing the annuity payments when they're paid in kind. And you also have issues on the back end about allocating GST exemption and how you can get finality in your inclusion ratio, and how you can get maybe finality on the transactions that might somehow get your non-exempt assets into your GST exempt trust. I think GRATs are really messy, even though they protect against a gift on the front end. There are situations when I would use them for sure, but they're the very strict minority. So a sale to beneficiary grantor trust. If you do the sale to the BDIT, so you have, maybe you're selling a business that's worth millions of dollars to a trust that has only $5,000 in it, that doesn't seem to have a whole lot of economic substance. And so the IRS might attack that. And there's a lot of people uncomfortable with it for that reason. So I do consider that type of sale to be more aggressive than the general sale to the irrevocable grantor trust. But there are cases when the client, maybe the client has already done the sales to trusts for other family members, and they would like to be able to have a trust for themselves. So mom or dad puts, say, $1,000, $5,000, whatever, into a trust. That's not withdrawal right lapse, and then they just sell into that trust. And since the sale is not a gift, the idea is that over time the note gets paid off, and when the note is done, then you have all this money inside the beneficiary trust. And because mom and dad are the grantors, it's not included in the client's estate. But again, that's very thinly funded. So how do you give it substance? So the biggest promoter of this says, well, I just do a loan guarantee and I pay a guarantee fee. I gave an example of that person, $10 million sale. He would do a guarantee of $2 million of that. The guarantee fee would be 2 to 5%. And so if you take on the low end 2% times the $2 million guarantee, that's a $40,000 annual guarantee fee. And so I said to that person, well, if you have a $5,000 trust that's promising to pay $40,000 a year, how does that give the transaction substance? And he said, oh, it means it's a more risky transaction, so I should have a higher guarantee fee. So clearly that person didn't really get it. So what I like to do is to either find ways to build up that small trust or have a companion trust. So how would I do the building up that small trust? So you may have some business opportunities that the client has. And so that maybe those business opportunities don't require a lot of capital. Or maybe the trust can borrow the money for those business opportunities. As long as the trust is borrowing from somebody else, it could still even borrow from the grantor as long as it's not buying assets from the grantor. Buying assets from the grantor is what I really get concerned about. If I'm loaning to the trust, so it's just going to be able to build a business, that doesn't concern me quite as much. Another thing that you can do is do what I would call a parallel trust, or some people might call it a sidecar trust. So what if the client's parents set up the small trust, but also set up another trust that's better funded? Then that trust is better funded, that has identical terms, can guarantee the loan. And the trustee, has a fiduciary duty to the beneficiaries to promote similar arrangements. What difference does it make what trust it is? A trust is just a relationship between a trustee and a beneficiary. So the trustee of the bigger trust would have a fiduciary duty to promote what's in the smaller trust as well. So the trustee of the bigger trust can just guarantee the loan that's used to sell into that smaller trust. Okay, fiduciary income tax and Code Section 678 trusts. So again, I mentioned this idea of the BDOT being taxed on income through an annual right to withdraw, and the idea that I'm not really comfortable with a sale to that type of a trust. But again, you don't really need to do it. You can do the BDIT, you can have the parallel trust, and have the parallel trust guarantee that loan. So that's what I would much rather do. You'll see in the first bullet point, the parenthetical that reference to 2J4F, which again is to my 2,600 pages of materials that are referenced in my newsletter. So that actually says how you could draft a right to withdraw just the income, the annual income for the year. And it talks about how to phrase that and how to design the lapse to be able to maximize the lapse and try to capture all of your taxable income. You should consider the relative federal and state income tax rates of the trust compared to the beneficiary. A non-grantor trust might be a non-resident trust in a particular state, whereas the beneficiary might be in a high income tax state. So you need to consider a lot of those issues. Also, the deduction is allowable because the trust is a separate taxable entity. A trust can get a deduction of up to $10,000 in state income tax. A beneficiary can get a deduction of up to $10,000 of state income tax. So if you have a non-grantor trust and a beneficiary, you've got $20,000 of state income tax deductions there. But if it's a beneficiary deemed-owned trust, then everything appears on the beneficiary's tax return, and you just get one $10,000 state income tax deduction. And there are other deductions like tax prep fee and trustee expenses that are not investment management fees. You have several other things that are fully deductible at the trust level that would not be deductible at the beneficiary level, and those are all referred to in my materials. So this roughly half hour that I did on beneficiary deemed-owned trusts, I have expanded it to an hour, and I do webinars through CPA Academy. They're free webinars, and they provide not only Missouri, Illinois, and California CLE, but they also provide CPE for CPAs. And you can see I have an expanded version of that. If you click on the link there, it'll take you to that webpage so you can sign up for that free webinar if you want to have a little bit more in depth on these issues. Okay, so now we'll get into making large taxable gifts. I'm going to talk about the effect of large taxable gifts on the estate tax calculation and how the benefit of that might be disallowed at some point. I'm going to talk about how a preferred partnership that intentionally violates Code Section 2701 can generate a large taxable gift while the donor still gets to retain significant benefits. Talk about grantor retained income trusts as another way to make these large taxable gifts, and also about triggering Code Section 2519 and Q-tips. When 2519 is a provision that says that when a spouse renounces her interest in part or all of the income of the trust, it's a deemed gift of the entire income in the trust. I also talk about spousal limited assets trusts, faces step-up issues, and planning for future transfers to the family once lifetime gift and estate tax exemption is used up. And so this last 40-minute segment, that's what we're going to talk a little bit more about when we have the WebEx meeting that starts 10 minutes after this webinar is over. Okay, first, effect of large taxable gifts. So here's the issue, and we had this issue back in 2012. We had a $5 million exemption. It was scheduled to go down to $1 million in 2013. So a lot of people would make a taxable gift of $5 million so that they could use up their exemption while it was still high. Well, let's pretend for a moment that the $1 million exemption had become permanent instead of getting raised up to $5 million index as it did. So let's suppose that somebody died in 2013 with that hypothetical $1 million exemption. So, but you made $5 million of gifts. So what happens? Does that $4 million difference somehow come back to bite you? You get taxed on it? Or when you died, you just get a $5 million exemption because you used it up. And so that question was called clawback. And when 2017 tax reform essentially doubled the exemptions, and it doubled those just until the end of 2025, and then it was going to revert. Then it's scheduled to revert back to $5 million indexed in 2026. That's what the law currently says. Then the question is, if you made these big gifts, then would it be clawed back? Just like we were talking about the $5 million and the $1 million, there was a potential to have happened back in 2012, 2013. So 2017 tax reform had a provision that expressly authorized promulgating anti-clawback regulations. Regulations that said, if you make a gift of your whole exemption and it later goes down, you still get to use that whole exemption when in your estate tax calculation, if those assets are included in your estate. And you'll see up there 2H12 as a reference. The preamble to the anti-clawback regulations is fabulous. It goes through exactly how you do these calculations and how you get the benefit from having made these large taxable gifts. And so the issue here is that what happens if you let me see what I did. So if you make these gifts and you totally give the money away, then the anti-clawback rule will say fine, you're going to be fine. However, the taxation section of the New York State Bar Association wrote in comment to the proposed anti-clawback regs and said, well, what if you didn't really give it away? You just kind of sort of gave it away. So what if you gave it away, but you retained the use of the property, so it got included in your estate? Would you still be able to use that amount? And he said, maybe, Treasury, you should consider that if somebody makes this gift that's just kind of sort of like an artificial gift, that you won't give them that credit for having made a gift, because the whole point of the anti-clawback regs, according to the New York State Bar Association section of taxation comments, was to help people who really truly got rid of the property. So the Treasury said, yeah, okay, we'll reserve on that. We'll reserve the right to promulgate regulations like that. In fact, we're reserving them under a clause called anti-abuse. So they said specifically that if you have a grid, and I'm going to explain what that is, or another taxable gift that results in estate inclusion, then those anti-abuse regs would target those if they ever promulgate them. Also, when you have a preferred partnership that violates Code Section 27.101, which again I'm going to get into in a moment, that's kind of an artificial gift too, and we might go back and change those regulations and nail you for making that artificial gift of that bonus exclusion amount, that extra amount that the anti-clawback regs were gonna give you the benefit of. So we're going to go through and talk about gifting strategies and about planning in case they do anti-abuse rules. To my knowledge, the government has not promulgated proposed anti-abuse regulations. I don't know what their status is. I don't know if they're going to do it. As the author of those comments mentioned to me, and tell others, many people in public, he said, look, this anti-abuse rule was reserved under a Republican administration, and maybe you think they're not going to go after them right now, even though they reserved it. But what if you get a Democratic administration? Then they'll probably go after it. So that person says, don't take lightly the possibility of these anti-abuse regulations. All right, so let's go into the preferred partnership violating Code Section 2701. So this is on slide 17. So what does Code Section 2701 provide? So back before the Tax Reform Act of 1986, people would recapitalize their corporations, and they would have preferred stock and common stock. So any dividends that got declared would first have to go to the preferred and satisfy a particular preferred rate of return, and only after the preferreds got their stated rate, could the rest of the shareholders get a dividend? So people with a lot of money would take they would put money in corporation, and they would say, okay, I am going to give away the common, I'm going to keep the preferred. And what I kept is, this potential stream of preferred payments. And I'm going to an appraiser, I'm going to have the appraiser value those preferred dividends. And then that would reduce my taxable gift. And so, and particularly when inflation was high, they put a lot of value on those preferred payments, and they would discount the common. And then what happened? Well, the people who own the preferreds would not always take the dividends. And the IRS would say, hey, you would take the preferred dividends, but you took credit for it when you made the gift of the common. You're really making a gift to the common shareholders by not taking your preferred payments. And I think the IRS kind of had a point there. On the other hand, what if the business says, hey, we didn't make a dividend on the preferred because we needed the money. We decided we needed to expand. We decided there were some risks that were coming up. Saving up for one day having a COVID or something. Saving up for a disaster. Saving up to buy somebody out. Well, all kinds of reasons. So sometimes the IRS would win a case, sometimes it would lose a case. But in 1986, Congress said, that's enough. We're going to have some rules that if you play games with your entities, we're going to have some extra state inclusion. And that was Code Section 2036C. Well, that wound up being a big mess. They had proposed regulations that I don't know how long, maybe like 80, 90, 100 pages long, and widely criticized by the estate planning bar. And eventually Congress saw the light. They realized it was a big mess. And in 1990, they enacted Chapter 14 to curb these perceived abuses. And so what they said in Code Section 2701 is, if you have a preferred stock or preferred partnership interest, then you have to have an interest that is definitely going to get paid. And if you don't pay it within 4 years, you're going to get hit with the gift tax. And if you don't have this preferred that is pretty certain to get paid, then we're not going to give you credit for keeping it. And you're going to have a gift of the whole thing. So, normally when we plan, we just want to have the preferred and get credit for having retained an interest in it. But if you're trying to make a large taxable gift, hey, just don't comply with 2701. You make a taxable gift of the whole thing. You're still receiving the income back. And then when you die, your preferred interest is included in your estate, but you made the taxable gift, so you get an offset. So that's the idea from that. When you do have this artificial gift that they say you're not getting credit for the preferred dividend right that you retained because you violated 2701, so you made a gift for the whole thing, and then when you get then you get your preferred interest back, your preferred dividends, that's kind of like a gift tax nothing. What if you fail to take the preferred distribution? Well, there might or might not be a gift. As I mentioned before, there's all kinds of reasons why you might not get a preferred distribution. If there is a gift element, then the fact that you already got hit with having made a gift will offset that gift. So what you do is you look at what's the gift you made versus what your retained interest would have been worth without that, and you get credit for that difference. And then that credit you get for that difference, you get to use that. And that credit can be used at your death, or it can be used to offset the gifts that you make during your life by not taking the preferred distributions, if indeed that is a gift. So you'd like to preserve as much of that credit. They call it a statutory mitigation provision. You want to preserve as much of that as you can for your death. So you want to avoid your making any gifts by not taking your preferred. So you'd want to kind of draft to avoid making a gift from failing to take preferred distributions. And my materials talk about that a little bit. And those who are in ACTEC, there's materials from the October 23rd webinar that Diana Zadel put together on powers to think about. For those of you who are not in ACTEC, you ought to work with an ACTEC fellow, and then you'll get it taken care of. Okay. Let's go on. The next is grits. And I'm not talking about the Southern Comfort Food. I'm talking about a grantor retained income trust. And this is a similar perceived abuse to the preferred partnership. In a grit, before they had these rules in 86 and 1990, before that, what they would do is a grantor would say, okay, I'm transferring money to a trust. I'm retaining the income for 10 years. And at the end of 10 years, I don't have an interest in the trust anymore. And then they would take credit for the deemed income the income they would have been deemed to receive from a gift tax viewpoint. And then the trust would turn around, even if it was mandatory income, the trust would invest in something that didn't generate a lot of income. So the donor might have gotten credit for having 6% income coming back to him or her, but in fact, maybe only 1% came back to him or her. Annual income is what I'm talking about. So Congress said, enough is enough. If a donor retains an interest in the trust, we're not going to give the donor any credit for that. We're not going to subtract the value of that retained interest unless it's the form of a qualified annuity interest, which would be a grantor retained annuity trust, qualified annuity interest, grantor retained annuity trust. So you've all heard of GRATs, or at least most of you have. So there are other exceptions. This is Code Section 2702. There are other exceptions to it, like qualified personal residence trusts and other variations on GRATs. So there are other exceptions, but just focusing here on this retained income. So with a GRIT, you don't get credit for having received this back. So again, you get to use up your in our example of $11.5 million exemption, for our year end, you get to use all that up, even though you've retained something, and even though it would be included in your estate. And we'll talk in a moment about how to get about these anti-abuse rules. But so a GRIT is an irrevocable grantor trust. You can do sales to it as well. For generation skipping transfer tax purposes, if you allocate GST exemption to the trust, you do get to allocate the exemption. It's pretty clear that you get to allocate the GST exemption, but your inclusion ratio is not set. So like normally, if you make an $11 million gift to a trust, and you allocate $11 million of GST exemption, then the whole thing is protected by your GST exemption, so you have a zero inclusion ratio. That's not how it would work with a GRIT. Any time that the trust could be included in the grantor's estate, you're not allowed to set the inclusion ratio. Rather, you wait until it is no longer included in the estate. So you don't get to set the inclusion ratio until the termination of the estate tax inclusion period, the ETIP. So let's suppose, example, you fund a GRIT with $11 million. The GRIT grows to $15 million, and it's worth $15 million on your death. So your death is when the ETIP ends, because after it's got to include in your estate, and after you die, there's no more estate to be calculated beyond the date of death. So your ETIP will close at that time. So if you allocate $11 million to that $11 million gift, you don't have a zero inclusion ratio. Instead, you have a $15 million value at the time the ETIP closes. So you have 11/15 is protected from GST tax, and 4/15 is not. So it's messy. But at least you get to use up your GST exemption. You get to allocate it. Now, in order to make it a completed gift, generally it should be in a trust that it does not have, it's a trust that respects self-settled splinter trust, which is also called a domestic asset protection trust or ADAPT. So if you're in one of those states, like Missouri, where I'm headquartered, then you can have these trusts and your creditors don't have access to it if you draft it correctly. On the other hand, if you're in a state like Illinois, where we also have an office, the grantor's creditors can access the maximum amount that the trustee could ever distribute to the grantor. And if the whole trust could possibly have been distributed to the grantor, then the entire trust is technically accessible by creditors, and it's not a completed gift. So you would need, in those states, you would need to have a base that the creditors can't touch. And this fourth bullet point is an article by Eric Veman, an ACTEC fellow from Houston, about an enhanced grantor retained income trust. And the idea is that you would have a particular portion of the trust that can never be distributed to the grantor. And so that part would be a completed gift. The other thing that you can do with the GRIT is if you appoint an independent person, they could have the power to decant the trust to a trust where the donor is not a beneficiary. So, for example, you have a married couple and they have descendants, and the husband wants to make a gift and use up his exemption. But they have low basis assets and they would like to keep it in their estate for estate tax purposes to get the basis step up. So what you do, you create the GRIT. And let's do my example of an $11 million GRIT. Suppose the assets grow to $15 million. Well, you would consider having a special trustee or an independent person take that $4 million excess and move it over into a trust for the surviving spouse and descendants. And that way the surviving spouse will still have access to it. And we do that with a high basis assets because those assets don't get the basis step up. Meanwhile, the $11 million that you left behind has low basis, it gets basis step up, and it's going to use that $11 million exemption. Now, if the anti-abuse rules come in, then there'll have to be a hard decision made. Do you move everything over into a trust for the spouse and kids and lock in the use of your estate tax exemption, or you keep some of those assets because you want to get the basis step up? And to what extent do the anti-abuse rules come in? They might come in for the whole thing, but more likely they would come in only for the excess over the basic exclusion amount. So the first about 5.7 million or whatever it is now might be protected from estate tax, but the excess that you gave away would not be protected. So maybe you keep 5.7 million of low basis assets, and then give away all that excess to the trust for the spouse and the kids. So a grid is subject to these anti-abuse regs potentially, but there are ways to handle it. But what you want to do is to be able to draft it in now with that thought in mind. All right, let's go on to Q-tip trusts. So again, the goal here is to trigger a gift to use up your exemption while you still have access to it. So let's suppose we have decedent dies, because of course that's what decedents do, and leaves a marital trust for the surviving spouse. So now the surviving spouse has the surviving spouse's deceased spouse unused exclusion, which is called DSU, and the surviving spouse also has her own exemption as well. And the surviving spouse would like to use up her exemption. Now, the first thing to mention is that whenever you have DSU is always the first exemption to be used. So if there's $11 million of DSU and $11 million of the surviving spouse's own exemption, you'd have to make a $22 million gift to be able to use up all of the surviving spouse's bonus exemption. All right, but let's suppose you have this Q-tip trust and the donee spouse renounces 1% of her income interest, and then that triggers a gift of the entire income interest. So that will use your taxable gift, so you can use up all the exemption. And then the donee spouse is keeping 99% of the income. So the donee spouse is still sitting pretty with that, despite having made the big taxable gift. Now, if you don't want to accelerate the entire trust, you need to split off the trust before you do a renunciation. So you divide the trust, and then you give up the 1% of the portion that you want to make the taxable gift over. Now, what if the surviving spouse renounced income and principal? Would that accelerate the remainderment? I don't know. It depends on state law. But I would not necessarily draft in anticipation of this issue. And here's the issue. When you have a Q-tip trust, the spouse has to be the only person who can receive it during the spouse's life. So if you draft in a way so that somebody else can get it during the surviving spouse's life, then it wouldn't qualify for the marital deduction. On the other hand, Code Section 2519 contemplates the spouse giving something up. So the giving something up in 2519 is a little inconsistent with the idea from the marital deduction rules that say that nobody else can get the property. So, in my view, the preferred approach is to allow the spouse to renounce her interest, which is totally consistent with 2519, but not to draft anything that expressly states that the remainder may get accelerated. If state law accelerates them, well, then so be it. But I'm worried about the marital deduction otherwise. Now, any retained interest in the trust is going to trigger 2036 inclusion in the surviving spouse's estate. So those are pretty much the issues on that. And again, the thought may be that the government would probably recognize the use of the DSU. I mean, we know it recognizes the use of the DSU. There's a regulation in the portability regs that specifically says that you get to use DSU when you do a 2519 transaction. But again, what about the excess of the DSU? Again, if there's an anti-abuse reg, my guess is that you still get to use your base exemption amount, but that bonus amount is probably what they would target. All right. Now let's get away from these trusts that you trigger the taxable gift and you have a state inclusion. So we'll get away from that. And let's just talk about one that we know will be absolutely respected. And that's what we call a spousal limited access trust. And people call them SLATs. And they've been used, I mean, this acronym is relatively recent, but quite frankly, people have been doing SLATs for years and years and years and years. Whenever you have a single life policy, typically the grantor is the insured, sets up a trust for the grantor's spouse and descendants. The spouse is the trustee. The spouse has a limited power of appointment. The spouse is a beneficiary. Those are SLATs. People call them irrevocable life insurance trusts or ILITs, but those are also SLATs. So first of all, with the SLAT, you can't turn off the grantor trust status because the spouse is the beneficiary. So I always put in a non-beneficiary trustee who can make distributions for the beneficiary spouse's welfare. So that way, when the grantor has to pay the income tax on it, the trustee could make a distribution for the beneficiary for the spouse, and then the spouse can use that money to pay income taxes. Now, consider the effect of divorce. Code Section 682 has provided relief for SLATs when somebody got divorced, got repealed with 2017 tax reform. And so now we have a potential mess. If you have a SLAT, then one of the things which I've seen recommended by the leading expert in this area was just that the ex-spouse, by the way, the ex-spouse still counts as a spouse for grantor trust purposes. We based on Code Section 672 parentheses E. This is all my materials. That's the best guess, but we don't really know. And we would like to see the government promulgate regulations that would say that upon divorce, they're going to cut off the 672E spousal attribution. But for now, if you were married at the time that the trust was created, then the spouse is considered to be the same as the grantor under the grantor trust rules, even if they get divorced. You have to assume that. We don't know for sure that's a law, but you need to assume it when you plan. And again, we'd like to see guidance. Right now, it's not high on IRS's list, so I really hope that people will put in some comments to encourage the government to consider that issue. By the way, I've encouraged people to send questions for the chat. Of course, you can wait until we have our webinar. Our WebEx meeting, but certainly I'm happy to look at questions from the chat here as well. So encourage you to do that. And when you put it in the chat, you could even give a hint as to whether you want an answer before the webinar or have an answer during the WebEx. Okay. So the other thing about divorce, a way to get rid of that problem is you could just say when you get divorced, the spouse is no longer a beneficiary. And a lot of state laws have that as their default. You can override it, but that's their general rule unless you override it in your trust agreement. And I mean, that may sound like a good idea, but when people are getting divorced, they're splitting up their assets. And we need to make sure that each spouse in the couple is going to have enough to live on after the divorce. If you cut out the spouse beneficiary from that trust, then that trust is just for the benefit of the kids. So now that trust is outside of the pool that's available for the parties in divorce, and it makes divorce a lot more of a hardship to the parties. So there's a lot of judgment in this, and I can't say there's a right or wrong answer for what you need to do. Another approach that you can take for this is you could give an independent person a power of appointment broad enough to include the grantor. So, for example, an independent person may have has a current power of appointment and can appoint the trust property to any descendant of the grantor's parents. Well, the grantor is included in that list of people, so the grantor can potentially do that. Jonathan Botmacher and others wrote an article about this. I think they called it like a spa trust or something like that. I don't remember what they called it, or a slant or something like that. Anyway, the idea here is that the grantor is not a beneficiary until that power gets exercised. So the argument is that the grantor's creditors can't reach that property because the grantor is not a beneficiary yet. Whether that works, I don't know. It would depend on state law. It would depend on cases, most likely, and case law which hasn't been developed yet. That may or may not be a good idea. If the independent person does not know about the trust at the time it's signed, then there's no prearrangement that independent person would ever appoint the property back to the donor. So that can cut off the IRS 2036 arguments. So the donor is not a beneficiary of the trust. The person who could benefit the donor doesn't even know about the trust when it's signed. So therefore, there couldn't be any prearrangement at the signing. That's the argument. Okay, let's talk about basis step-up issues regarding large taxable gifts. When you get gifts outside the estate tax system, there is no basis step-up. So that's a big disadvantage. There's a formula in that first bullet point. There's a reference to the part that has a formula that compares the estate tax savings of growth compared to the income tax savings of basis step-up. We're working on preserving the benefit of the estate tax exemption, so that formula is not the be-all and end-all. I talked about the GRIT strategy. Also considering making a gift to an irrevocable grantor trust where the grantor's parents have a general power of appointment. Perhaps it's exercisable only with the consent of a corporate trustee, and therefore there's really not much of a danger that this is ever going to get exercised, but you can use the parent's exemption to get the basis step up. That was coined the accidentally perfect grantor trust, and ACTEC fellows Mickey Davis and Melissa Williams have that on their website. And it's also referenced in my materials. Future transfers to family once you use up the gift tax exemption. So, think about the fact that the client may go over in their gifting in the future because they want to help out their family members. So when they're doing gifting now, they ought to consider providing for the family members in those trusts to make sure that any family members they might be making a big gift to, that it's done through that trust. I like the idea of the client's parents setting up the Beneficiary Deemed-Owned Trust with a bequest to an identical trust to guarantee any loan. So that way the client can do loan transactions selling assets to that trust. So here's links to my CPA Academy webinar page. I have a webinar on formula transfers for estate planning. The first 20 to 30 minutes goes over irrevocable grantor trust in more detail, and then the last hour goes through all kinds of formula transfers that you can use to try to protect your donors from gift tax. I did have a question that asked, if you pay gift tax on a real property gift, does the donor receive a step-up in basis? And the answer is yes. The gift tax is then prorated among the property's value, and the portion of the value that constitutes appreciation will get additional basis from that gift tax. That is somewhere in my materials. Anyway, we've reached the witching hour. If any of you does not subscribe to my quarterly newsletter, I encourage you to. I encourage you to go to my CPA Academy webinar page, and you can see current webinars. Check it once a month to see if there's any free webinars. It'll give you free COE and free CPE for those of you who are accountants. And I encourage you to, again, save the date, January 26th. I'll have a webinar for my fourth quarter newsletter. Thank you very much. And for those of you who are able to attend my WebEx meeting, I look forward to talking with you in 10 minutes. Thank you.